You know what's fascinating about silver? For decades, people have been screaming about manipulation. Conspiracy theorists, they were called. Tinfoil hat crowd. And then, quietly, without much fanfare, the courts proved them right. J.P. Morgan paid nearly $1 billion in fines. Traders went to prison. The manipulation was real. Case closed, right? Wrong. Because here's what nobody's talking about. That case? It just got reopened. And the implications of what's happening right now could send shockwaves through the entire precious metals market. We're talking about a situation that makes the original scandal look like child's play. Let me take you back to 2020. J.P. Morgan Chase, the largest bank in America, admitted to manipulating precious metals markets for nearly a decade. They paid $920 million in fines. Their head of precious metals trading, Michael Nowak, was charged with racketeering, the same charge they use against mob bosses. Think about that for a second. A major bank executive charged under RICO statutes for manipulating silver prices. The scheme was elegant in its simplicity. They'd place massive buy orders to drive prices up, then cancel them at the last second. Or they'd flood the market with sell orders to crash prices, only to pull them before execution. It's called spoofing, and they did it thousands of times. The evidence was overwhelming. Chat logs, trading records, whistleblower testimony. They got caught red-handed. But here's where it gets interesting. That case focused on a specific period, roughly 2008 to 2016. The prosecutors built their case around documented instances of spoofing during those years. They won. Justice was served. Everyone moved on. Except some people didn't move on. Some people started asking uncomfortable questions. Like, if J.P. Morgan was manipulating silver for 8 years and got caught, what makes anyone think they stopped? What about before 2008? What about after 2016? And more importantly, what about right now? Fast forward to 3 months ago. A federal judge in Manhattan made a quiet ruling that barely made the news. She agreed to reopen discovery in a related civil case. New evidence had emerged. Evidence suggesting the manipulation never stopped. It just got more sophisticated. The new allegations are stunning. We're talking about coordination between multiple banks, not just J.P. Morgan. We're talking about algorithms designed specifically to suppress silver prices during key trading windows. We're talking about a level of market control that would make the original scandal look amateurish. And here's the kicker. The timing of this reopening? It coincides with something extraordinary happening in the physical silver market. Something that suggests whoever's been controlling prices might be losing their grip. Look at the data from the last 6 months. The disconnect between paper silver and physical silver has never been wider. On the COMEX, where paper contracts trade, silver's been relatively stable, hovering around $23, $24 an ounce. Nothing too exciting. But try to buy physical silver right now. Go ahead, try it. Dealers are charging premiums of $4, $5, sometimes $6 over spot price. That's a 20 to 25% markup. And that's if they have inventory. Many dealers are showing delivery delays of 4 to 6 weeks for a commodity that's supposedly in abundant supply. This is not normal. In a functioning market, these kinds of premiums don't persist. Arbitrage traders would step in, buy paper silver, take delivery, and sell the physical at a profit. The premium would collapse within days. But it's not collapsing. It's widening. Why? Because taking delivery from the COMEX has become increasingly difficult. The exchange has implemented new rules, new requirements, new hurdles. It's almost as if they don't want people taking physical delivery. Almost as if the paper market and the physical market are two completely different animals. Let me tell you a story that illustrates this perfectly. Last month, a mid-sized hedge fund decided to take delivery of silver from the COMEX. Nothing crazy, just 5,000 ounces. Standard contract. They'd done it before without issues. The process that normally takes 2 weeks stretched to 7. First, there were paperwork delays, then warehouse availability issues, then transportation problems. Every step of the way, new obstacles appeared. When the silver finally arrived, the fund's manager did something unusual. He had it assayed, tested for purity. 3 of the bars came back at 99.7% purity. COMEX good delivery standards require 99.9%. Those bars shouldn't have been in the warehouse in the first place. But there they were, certified and ready for delivery. Now you might think this is just sloppy quality control, but here's what makes it suspicious. When the fund complained, the COMEX response was essentially, take it or leave it. No apology, no explanation, just a shrug. This is the largest precious metals exchange in the world. They don't do sloppy. Which raises the question, what's really going on in those warehouses? The reopened case is digging into exactly this question. Discovery documents are revealing something fascinating. The amount of silver claimed to be in COMEX warehouses doesn't match up with the amount that's actually available for delivery. There's registered silver and eligible silver. Registered means it's available for delivery against futures contracts. Eligible means it's just sitting there, not allocated to any contract. Here's the thing. Silver can move between these categories instantly. One day it's eligible, the next day it's registered. The exchange reports these numbers daily, and over the past year, something strange has been happening. The registered category keeps shrinking. We're now at levels not seen since 2016. Just 47 million ounces registered. That sounds like a lot, until you realize that's only about 9,400 contracts worth of silver. On any given day, there are over 150,000 open silver contracts on the COMEX. If even 10% of those contracts stood for delivery, the exchange would be cleaned out, completely empty. And everyone in the market knows this. This is what's called a fractional reserve system. The same concept banks use. They don't keep all your deposits in the vault. They lend most of it out, keeping just enough on hand to meet normal withdrawal demands. It works fine until everyone wants their money at once. Then you get a bank run. The silver market is set up the same way, and the reopened case is examining whether this setup is intentional, whether it's designed to allow price manipulation. Because if you control the paper market, and you know the physical market can't actually deliver on all those paper promises, you can set prices wherever you want. Think about the incentives here. Who benefits from low silver prices? Well, anyone who's short silver. Anyone who's sold promises to deliver silver they don't actually have. And according to the Commitment of Traders reports, the big banks have been net short silver for years, consistently, relentlessly. Now, being short isn't illegal. It's a normal part of market making. But being short when you know you can't deliver? That's fraud. And if you're actively suppressing prices to avoid a delivery squeeze, that's manipulation. The evidence emerging in this reopened case suggests both might be happening. Internal emails from 2019 and 2020, recently uncovered, show traders discussing managing the delivery problem. Not solving it, managing it. As in, keeping it under control, making sure it doesn't blow up. One email, dated March 2020, is particularly damning. A senior trader writes, "We need to keep the specs from standing for delivery. If more than 5K contracts demand physical, we're in trouble." 5,000 contracts. That's 25 million ounces, half of what's currently registered. The response from his supervisor? Understood. We'll coordinate with the others. The others, plural, meaning this wasn't just one bank. This was coordinated. Now you might be wondering, if this manipulation is real, why hasn't silver crashed? Why isn't it at $10 an ounce? And that's actually the brilliant part. They're not trying to crash it. They're trying to contain it. Keep it in a range. Prevent it from breaking out. Because here's what they know that most people don't. The fundamentals for silver are explosive. Industrial demand is soaring. Solar panels, electric vehicles, 5G infrastructure, all of it requires silver. Lots of silver. We're talking about 1.2 billion ounces of annual demand. And production? It's barely 800 million ounces from primary silver mines. The rest comes as a byproduct of other mining operations. That's a 400 million ounce deficit every single year, and it's growing. The Silver Institute projects demand will hit 1.4 billion ounces by 2030. Where's that silver going to come from? The answer, historically, has been above-ground stockpiles. Silver that's already been mined, sitting in warehouses and vaults. But those stockpiles are shrinking. Fast. Government stockpiles are essentially gone. The U.S. Strategic Silver Reserve was sold off decades ago. China's state reserves are opaque, but analysts believe they're being drawn down to meet industrial demand. What's left are private stockpiles, investment silver, bars and coins held by individuals and institutions. And increasingly, that silver is moving from west to east, from COMEX warehouses to Asian vaults, from ETFs to private hands. This is the squeeze that's building, and the people who've been manipulating prices know it. They can see the same data everyone else can see. They know the math doesn't work. They know that at some point, the physical market is going to overwhelm the paper market. So what do? They fight to maintain control for as long as possible. They use every tool at their disposal. Spoofing, wash trading, coordinated selling during thin trading hours. Anything to keep prices contained. But it's getting harder. The physical demand is relentless. And now, with this case reopened, they're facing legal pressure too. Discovery is forcing them to reveal their positions, their strategies, their communications. Things they'd rather keep hidden. Here's where it gets personal for a lot of people. If you're sitting on retirement savings, if you've got a 401k or an IRA, this matters to you. Because when this silver situation finally breaks, and it will break, the ripple effects are going to hit everything. Silver's not just a precious metal. It's an industrial metal. It's in your phone, your computer, your car. When silver prices spike, manufacturing costs spike. When manufacturing costs spike, consumer prices spike. We're talking about inflation on steroids. And here's the thing about inflation. It destroys purchasing power. That retirement account you've been building for decades, its real value can evaporate faster than you think. We saw it in the 1970s. We're seeing it again now. And if silver breaks out the way the fundamentals suggest it should, we're going to see it accelerate. Now, I'm not here to sell you anything, but I do want to mention something practical. If you've got $100,000 or more in retirement accounts, there's a strategy worth understanding. It's called a gold IRA, and it allows you to hold physical precious metals inside your retirement account. Tax-deferred or tax-free, depending on your account type. I put together a free guide that explains how it works, covers the rules, the process, the pros and cons. It's in the description below. No obligation, just information. Worth checking out if you're thinking about diversification. Anyway, back to what's happening in the courts. The reopened case is moving faster than anyone expected. Discovery deadlines are tight. Depositions are scheduled. And the banks are fighting hard to keep documents sealed. Which tells you something right there. If there was nothing to hide, why fight so hard to hide it? The plaintiffs in this case, they're not just random investors. They're sophisticated funds, family offices, even some smaller banks that got burned by the manipulation. They have resources, they have expertise, and they're not backing down. One of the lead attorneys gave an interview last week. Didn't get much coverage, but what he said was revealing. He claimed they have evidence of manipulation continuing through 2023. Not historical manipulation, current manipulation. And he said the scale of it dwarfs what JP Morgan admitted to in 2020. If that's true, if even half of that's true, we're talking about the biggest financial scandal in decades. We're talking about a market that's been fundamentally broken for years, and we're talking about a reckoning that's coming. Because here's the thing about manipulation. It can only last as long as the manipulators have ammunition. As long as they have silver to deliver, or the ability to convince people they have silver to deliver, they can keep the game going. But once that credibility cracks, once people start demanding physical delivery and size, the whole thing collapses. And we're seeing signs that crack is forming. Look at what happened in March of this year. A large Asian buyer, rumored to be connected to the Chinese government, took delivery of 15 million ounces from the COMEX. That's 3,000 contracts. It was the largest single delivery in over a year. The silver market barely reacted. Prices went up a few cents, then settled back down. But behind the scenes, there was panic. Warehouse operators were scrambling. Bars were being moved from eligible to registered. Phone calls were made. Deals were cut. Why? Because that 15 million ounces represented nearly a third of registered inventory at the time. If another buyer had stepped up and demanded the same, the exchange would have been in serious trouble. This is the tightrope they're walking. Every large delivery request is a potential crisis. Every month that industrial demand exceeds supply is another month the deficit grows. Every ounce that moves from west to east is an ounce that's not coming back. And now, with legal scrutiny intensifying, with discovery revealing the inner workings of the manipulation, the pressure is building from multiple directions. Let me give you some historical context. In 1980, the Hunt brothers tried to corner the silver market. They accumulated over 100 million ounces. Prices went from $6 to $50 in a matter of months. The exchanges changed the rules mid-game, implemented position limits, and the Hunts were forced to liquidate. They lost billions. But here's what's different now. The Hunts were trying to artificially create a squeeze. What's happening today is a natural squeeze. It's not manipulation driving prices up. It's reality. It's supply and demand. It's physics. You can't consume more silver than you produce indefinitely. Eventually, you run out. And when you run out of a metal that's essential to modern technology, that's used in everything from solar panels to medical devices to military applications, the price doesn't just go up. It explodes. The question isn't if this happens. The question is when. And what the reopened manipulation case is revealing is that the when might be sooner than anyone thinks. Because the banks that have been controlling this market, they're not stupid. They can read the same data we can. They know the squeeze is coming. And they're trying to unwind their positions. Quietly, carefully, without triggering the very squeeze they're trying to avoid. But it's like trying to sneak out of a crowded theater. The first few people can leave quietly. But once everyone realizes the building's on fire, it's a stampede. We're seeing early signs of that stampede. Retail demand for physical silver is at record levels. Coin sales from the U.S. Mint are up 40% year over year. Dealers can't keep inventory on the shelves, and premiums, as I mentioned earlier, are at levels that suggest serious supply stress. Meanwhile, the paper market continues to pretend everything's fine. Prices are stable. Volatility is low. The COMEX reports show plenty of silver available. But scratch beneath the surface, and the cracks are everywhere. Here's another data point that should concern anyone paying attention. The silver ETFs, the big ones like SLV, they're supposed to hold physical silver to back their shares. 1 share equals 1 ounce, more or less. But over the past year, we've seen unusual activity. Large redemptions. Authorized participants pulling silver out of the ETF. Where's that silver going? Some of it's going to Asia. Some of it's going to industrial users who are securing supply chains. And some of it's probably going to the COMEX to shore up registered inventory. But here's the problem. ETF silver is supposed to be separate from COMEX silver. They're different pools. If silver is moving between them to cover shortages, that suggests the shortage is worse than reported. And the reopened case is examining exactly this. Whether there's been commingling of silver that's supposed to be segregated, whether the same bars are being counted multiple times, whether the whole system is essentially a shell game. The implications are staggering. If the court finds that the silver market has been systematically manipulated, that prices have been artificially suppressed, what happens next? Do they unwind all the contracts that were traded at manipulated prices? Do they compensate everyone who was harmed? Do they shut down the COMEX until reforms are implemented? Nobody knows. There's no precedent for this. The JP Morgan case resulted in fines and some prison time, but the market structure didn't change. Trading continued. The same banks are still the dominant players, but this time feels different. This time, the physical shortage is real. This time, the evidence of ongoing manipulation is mounting. This time, the courts might not be able to just slap some wrists and move on. And that's what has smart money nervous. Because if the silver market breaks, if prices spike to reflect true supply and demand, the knock-on effects are unpredictable. Derivatives markets could seize up. Banks with large short positions could face massive losses. Industrial users could face supply disruptions. It's the kind of scenario that keeps central bankers up at night. And it's why you're not hearing about this on CNBC. It's why the mainstream financial media is largely ignoring the reopened case. Because acknowledging it means acknowledging that one of the world's major commodity markets might be fundamentally broken. But ignoring it doesn't make it go away. The physical shortage is real. The legal case is real. The squeeze is building, whether anyone wants to talk about it or not. So what does this mean for you? It means paying attention. It means understanding that the price you see quoted for silver might not reflect reality. It means recognizing that if you want to own silver, physical silver, you need to act before the crowd figures out what's happening. Because once this breaks into mainstream consciousness, once the evening news starts talking about silver shortages and manipulation scandals, it'll be too late. Premiums will be astronomical. Delivery times will be measured in months, not weeks, and prices will be multiples of where they are today. The smart money is already positioning. Central banks are buying gold at record rates. Sovereign wealth funds are accumulating physical metals. Family offices are diversifying out of paper assets. They can see what's coming. The reopened manipulation case is just the catalyst. It's the match that might light the fuse. But the powder keg was already there, built over years of deficit spending, money printing, and market manipulation. And here's the final piece that ties it all together. Silver's not just about investment. It's not just about making money. It's about preserving wealth in a world where paper currencies are being debased at an accelerating rate. Look at what's happened to the dollar's purchasing power over the past 50 years. What cost $1 in 1974 costs over $6 today. That's an 83% loss of value. And the pace is accelerating. The money printing during COVID, the stimulus packages, the infrastructure spending, all of it dilutes the currency. Silver, gold, physical assets, they don't get diluted. They can't be printed. They can't be created out of thin air. And that's why, throughout history, they've been the ultimate store of value. The manipulation case that just got reopened, it's not just about past crimes. It's about exposing a system that's been rigged against ordinary people. A system where big banks can suppress prices to benefit their trading positions while everyone else pays the price. But that system is cracking. The evidence is mounting. The physical shortage is undeniable. And the legal pressure is intensifying. What happens next is anyone's guess. But if history is any guide, when manipulated markets finally break free, the moves are violent and swift. We saw it in 1980. We saw it in 2011, when silver briefly touched $50. And we might be about to see it again. The difference this time is the fundamentals are stronger. The deficit is larger. The industrial demand is more critical. And the amount of available silver is smaller. This isn't about conspiracy theories anymore. This is about math. This is about supply and demand. This is about a market that's been artificially constrained finally breaking free. And when it does, the people who positioned early, who understood what was happening before the crowd, they're going to be the ones who benefit. Not because they got lucky, but because they paid attention, because they looked at the evidence, because they understood that sometimes the conspiracy theorists turn out to be right. The silver manipulation case just got reopened. The discovery is revealing uncomfortable truths. The physical market is showing signs of severe stress, and the clock is ticking. What you do with that information is up to you. But don't say nobody warned you.